We're going to get started today by looking at the front page of Yahoo Finance. Yahoo Finance is one of the best places on the internet to go for business news, especially about stocks. You can see the big news story of the week. Companies brace for messy tariff refund process. So the Supreme Court of the United States ruled that the um, tariffs the president imposed, a lot of them, were illegal, and it seems like they might have to be rolled back. And that's really good for stocks. I'm surprised that the stock market didn't go up more because every company was dealing with their own issues, passing on how to pass on pricing to customers. Actually, they did a study where most of the costs for the tariff were passed on to the customers. And if the companies get refunds, that's like s- um, making making the products that they sold marked up, and then they get a refund for the taxes, tariffs that they paid. So overall, it's a good thing for the stocks. But now we have this um, 15%, 10 or 15% global tax that's going to be imposed. It's just, I don't, I don't understand what's going to happen. No one really knows what's legal or not legal. So I'm going to have to put that on decide right now because I don't think anyone really understands what's going to happen in the next year with tariffs. But the big picture is companies, once they understand how the tariffs work, they adapt and they'll survive. And in a couple more years, we're going to have a new president and um, without this kind of issue, I think. So we'll see. But right now, this is a variable it's a pretty big variable in the cost of doing business, and it'll make the stocks go up and down based on, what happens here and what the ramifications of this is. So let's put that aside and look at the S&P 500. You can see that we're in like a very tight range for the S&P. You can see we're up and down like maybe two or 3% for the past since November. And we can see we're steady above the 100-day moving average, which is the green line. We have the 50-day moving average, which is the purple line, and the 20-day exponential moving average, which is the yellow line. So far, the S&P has been hugging those moving averages. And if we ever see a time when we break those moving averages, then we may turn from an uptrend, which we've had since April of last year, to a downtrend. So we'll see if that ever happens. And the reason why we're following trends like this is 90% of stocks in the stock market follow the S&P 500. So as the S&P 500 goes, so shall most of the stocks in the stock market. Okay, let's look at our talking points for today and our calendar. You can see we're at the end of earnings season. Our next big report is going to be NVIDIA this coming Wednesday. And NVIDIA, it's hard to predict what the stock market will do, even if they come out with great earnings and great projected estimates. They could still go down a lot or up a lot. It's all based on probably the how much options the options market because there's a lot of buying and selling of that stock based on how the options were played. So we'll see what happens on the 25th. But all signs are pointing to a lot of money being spent on NVIDIA chips. And we have double the projected spending on AI and infrastructure by the um, AI infrastructure and hyperscalers. So that's going to be the big story of this week. Then we go into March. March is traditionally a better month than February. You can see based on our average stock month, average historical stock market returns, March is probably one of the better months, and April is probably the best month of the year. So if we do get a pullback in February, just think about how great it's going to be whenever the weather gets better. And a lot of people associate, how good the stock market's going to do based on the weather in the Northeast, where most trading's done. So that's just a theory, but um, we'll see what happens after the earnings report comes out from NVIDIA. Um, the things we have to look forward to in March, we have the Fed meeting on 17th and 18th of March, and we have triple witching, which is which happens every quarter, once a quarter, simultaneous expiration of a lot of options. So it's going to be very volatile that day. We had options expiration, which happens um, the third Thursday of every month. So there was a lot of options activity this past Friday. And we don't have any holidays for a long time here. So we have a long stretch of time without a holiday. We have Easter, but that's not like a financial stock market holiday. We have a holiday at the end of May, Juneteenth, and we have 4th of July, which is observed on the 3rd. So usually 4th of July, people are excited. That's a well telegraphed holiday. People take time off and they feel good. So you expect a good couple of days around before and after the 4th of July in the stock market. August, September are traditionally some of the weaker months in the stock market. So our average monthly stock market returns negative 0.15 and negative 0.7% in August, September. So just keep that in mind. I like to keep it in mind whenever I have my eye on a stock and say it's in July. I know that we're going to have a couple bad quarters, bad months. So I'll wait to buy that stock until we have a sell-off or some kind of calamity during September. Okay, so let's look at some of our earnings that came out this week. Walmart, um, they disappointed on earnings. Um, they have a very high PE ratio, something like 40 or 50, and it is trading at a premium right now. And they had to report everything really good or it was gonna get hit. So they let's look at Walmart, the Walmart stock here. Hold on. There it is right there. Okay, so you can see the Walmart's been on a tear. It's been kind of immune to a lot of the market turmoil because in bad times and good times, people trade down from a Target, maybe go to Walmart. But you can see they had a huge correction here down to the bottom part of their trend line right here. But they're still trading at a PE of 48, and they're only growing like maybe 15% or 10 or 15%. So they're 3 or 4 times overvalued. So it's fun to watch. They pay a dividend, but right now it's super expensive even after this correction. So we'll wait for that one to um, to go down more before we can consider buying it. Okay, eBay reported this week, and um, we're basically at the end of the reporting season. A lot of the big stocks have already reported. Next week, we're going to have Home Depot, the big ones. They're part of the Dow. We have Dell and HP, and NVIDIA is the last big tech stock to report for the quarter. So, and we don't know if we know they're going to have great earnings. However, even if they have great earnings and they have great forward projections, they could still take a hit. If we look at their chart, let's look at their chart. You can see they're in a sideways pattern, even though they've their PE ratio has been coming down. They've had good earnings. Um, there's just been recently um, there's there are market participants that aren't um, rewarding these stocks like they used to. But it's in a sideways pattern. So if it does sell off, it'll probably sell off to this spot right here because there's like this pattern of sideways. Or if it does go up, it'll probably go up to the top of that pattern. So I expect it to go sideways like that, because that's the pattern it's been at. And it's overbought right now. So there's a better chance of it going to the bottom end of this channel than the upper chin because it's basically overbought. But if you own this for a buy and hold position, you don't want to be selling before you go into earnings and buying when it goes out of earnings because then you have tax responsibilities. But it's just I'm mentioning these whether it'll go up or down after earnings. Um, if you want a dollar cost into it, dollar cost means put a little bit at a time into the stock. Okay, let's look at let's look at some of our numbers for this week. The S&P is up 1% from the beginning of the week. Um, we still have we're still on a we're still losing a little bit of momentum in the stock market. There's a little bit of fear picking up in the market. We're overbought, and the S&P short range oscillator remains overbought at 2.53%. The 10-year went up this week 1%. It's been going down recently, but it did go up. So we expect a corresponding move to these sectors that are affected by interest rates. And stocks are above the moving averages, which indicate momentum. It doesn't have as much momentum. We're losing momentum, but we are in a positive um, uptrend right now. So until we break until okay, so if we follow our pattern here, until we break these trend lines, the pattern is going to be up. We're in an upward trend. It's like a chains it's like a saw up and down. And so we're in an uptrend and we do have momentum, but it's declining. And all right, so let's look at catalyst for the market to go down. Lack of confidence in the AI story. Okay, if NVIDIA says something on Wednesday that spooks the market, we're gonna have the market go down. And confidence, we have a lot of promises by companies that are big companies right now that are borrowing money um, to buy and build out the AI infrastructure. Um, and if there's any lack of confidence in these companies that are spending all this money in the AI build out, then people will sell the whole stock market. Okay, we have this tariff as a catalyst for the market to go down because we still don't know what's going to happen with tariffs. We had the Supreme Court ruled this week that the tariffs were illegal, but Trump just imposed another 15% tariff across every country in the world, which is it's getting to be ridiculous, but that could definitely affect the earnings and the stock market going up and down. So we'll see what happens there. Um, okay, things we're doing. in this environment, we're looking for low peg ratio stocks that are growing, that have lower valuations. Um, Safe business models that are consistent, they earn consistently over time and down a lot from historical averages. And we like to look at high yielding stocks to add to the income part of the portfolio. All right, so let's look at, we are actually towards the end of February. So we're going into March, which is seasonally a decent month. So let's look at, we already talked about the S&P. S&P is overbought. The S&P short range oscillator, I'm keeping track of this now. Anything that's positive is overbought. Anything that's negative is oversold. So the translation is when we're overbought, when it's positive or plus a 5 or more, right now we're at 3, 2.5. When it's above 5, we're exceeding 8, that suggests the market is overextended to the upside and due for a pullback. And when it's less than 5, less than -5, approaching -10, and it indicates the market is heavily oversold, so suggesting a potential rebound. Okay, so we're still overbought right now, according to that, and we'll keep track of this. This is a indicator that Jim Cramer likes to use a lot, and a lot of hedge funds use that also. All right, so let me see. We look at our 10-year Treasury. You can see went down until last week, and this week we went up like 1%. And so we saw a huge move in the indexes of the sectors that are very sensitive to interest rates. And this week we should have like an opposite move. Um, so I think that has something to do with the tariff situation. Let's look at, okay, the price of gold went up 1.3%. The price of oil went up 4.5%. And all of the energy stocks this year are on fire. They're up over 20%. Um, let me see. The dollar has started to go up a little bit, the dollar index. So if you look at our chart in the dollar, we're still in a downtrend, but you can see in the last week or so we're going up a little bit. So the dollar index going down in this chart indicates that the big tech companies are going to be beneficial, that the sales that they make overseas are going to yield more money because of the translation of the dollar to other currencies. All right, let's look at the fear and greed index. We're at fear right now. We were neutral last week. So our translation is start looking for things to buy. Okay, as with okay, let's look at the amateur in American Association of Individual Investor survey, which is they're bearish now. They were bullish for at least 7, 8 weeks in a row, and now we're bearish. So the translation is it's time to buy and don't sell. So we're going to start looking for things to buy now that people are fearful and the amateur investor is bearish. Okay, so let's look at the VIX. The VIX it's 19 it's 19.09, which is right around the point where fear is beginning. So we have some fear gripping the market. And in our emotional graph, we're at fear right now. When we get to the capitulation stage, that's when um, Jim Cramer says you want to hold your nose and buy something. Um, Hold on. Okay. So let's look at Okay, let's look at the worst at first. At the beginning of this year, we kept track of um, the sectors that did the best last year, which are communication services, IT, industrials, S&P 500, and financials. And as part of diversification and um, we wanted to see if the first would eventually turn into the worst. So right now, the best performing sectors from last year, communication services, IT, are the worst ones for this year. And some of the worst ones from last year are the best ones from this year. Energy is up 22%. Materials, which were up 10% last year, are up 16% already this year. So that's just an example of how sectors can do better or worse every year. So you got to have, for the best portfolio, you got to have a little bit of every sector to get a consistent, diversified return that's great every year. So at the end of this year, we're going to have probably, we're going to have energy up big, while the tech sector isn't doing so good. So I think what Jim Cramer calls it, um, he likes to play a game that are you diversified? And diversified is having a little bit of every one of these sectors in your portfolio so that over time you get a very even return, especially in good times and bad. All right, let's look at the S&P sector PE valuations relative to history. And I like to look at this, especially the most undervalued compared to history, because these sectors that are least these are these sectors up here are the most overvalued compared to history. And when looking for new positions, I like to look at the sectors that are out of favor um, for ideas. And when I do my stock screens, I try to look for the sectors such as energy, utilities, healthcare, real estate, and financials, because they are currently not selling for a premium. Right. So let's look at, okay, let's look at some of the stocks going up and down today. The U.S. market movers. Corning is a top stock today. Corning does a lot of the glass fibers for AI infrastructure. They do a lot of glass manufacturing for iPhones. Um, and let's look at a news story of why Corning is up today. Corning hits an all-time high as analyst hikes price target by 28%. And Corning soared, let's see, let's look at that guy. Um, UBS raised its price target for Corning to 160 from 125 while maintaining a buy recommendation. This followed the company's stellar earnings performance last year, with net income more than tripling to 1.5 billion versus only one. Oh, wow. 506 billion in 2024. Let's see why they're doing so good. Their higher net sales growth outlook over the next 2 years. They didn't say why yet. Hold on. They are a major beneficiary of Trump's tariffs and onshoring. Okay, so they should have the benefits that they received from the Trump's tariffs was counteracted by them undoing the tariffs today. So I'm not sure if that had anything to do with it. Okay, well, that was a good excursion. Let's look at some of the other market movers. Okay, we have a lot of AI infrastructure build out stocks in this top list. We have, and now a lot of these stocks that are going up and down have a lot to do with the tariffs that were unwound by the Supreme Court. We have a lot of companies that, like Alphabet, they benefit from the tariff situation because their Android operating system. Um, I have to find out a little bit more why, but they benefit. They had a big benefit for this Supreme Court ruling. We have SanDisk, that probably the same thing. Uh, Tariffs, they don't have to pay the tariffs, then they're more profitable. But if they're an AI infrastructure build out company, Expand Energy, a lot of the companies that do the solar panel and solar products, they don't have if they don't have to pay tariffs, then that makes them so much more profitable. Comfort Systems, they do some of the they're also benefited by the lack of tariffs because they don't have to pay um, tariffs on their products. So let's look at some of the ones doing the worst. CrowdStrike is big. Um, the AI. Let's look at the well the AI um, is trying to disrupt the software and the cybersecurity industries. Right now, there's a new product from one of the I think it's OpenAI or I think it is, but they had a cybersecurity product that find faults in software, and that made all of the cybersecurity stocks go down. So I think the Warren Buffett would stay away from a lot of the companies that are being disrupted right now in software. Um, Oracle, I think software, Datadog, these are all companies that are software related in the AI data infrastructure world. Arista Networks, ServiceNow, definitely. So there was let's do that search right now. We'll do a Google search on um, disrupt of cyber. There it is right here. Cybersecurity stocks fall after Anthropic unveils Claude code security. Okay, this is so we have to be very careful when we pick stocks to make sure that we don't find stocks that are going to last 50, 100 years. This is an example of an industry that could be disrupted by AI. I don't know how accurate this is, but every one of the cybersecurity stocks fell 8% or more today. So that's pretty scary. Um, so you can see there's a lot of CrowdStrike, 7%. Wow. Okay, and all these are AI infra no, these are software stocks that are being disrupted. ServiceNow. Okay, so that's pretty scary. A lot of people right in in the stock market right now are moving towards um, stocks that are more old school. So that's okay. So let's look at some of the sectors going up and down. Change. Hmm. We look at our 10-year. We have like an increase in the 10 years in the yield. So it went up like 1% since last week. So if the interest rates go up, let's look at our cheat sheet. Yields of the 10-year going up. It's positive for companies that don't need to borrow money. And that's in general. And companies that don't pay a dividend. So whenever it's negative for companies paying a dividend or anything home builders. Let's see if that that came to fruition here today. ETF sectors. Okay, so we have oil down, energy down, biotech down. Okay, as the interest rates go up, companies that need to borrow money will have to pay more to borrow money. So that's bad for biotechs because biotechs are heavily indebted. Um, Companies that pay a high dividend are going to suffer because if the interest rates go up, then there's a less demand for stocks that pay dividends. Telecom, very similar situation. They paid high dividend, so they're in less demand when interest rates go up. Let's look at the stocks going up the most. Gold, okay, we know the price of gold in general has gone up 1.5% this week. That's why the gold might be going up. Semiconductor ETF has gone up. Um, that could be because of tariffs. If there's no tariffs, then most semiconductors are imported. Bank ETF, home builders ETF. If the interest rates go up, that's not good for the home builders. However, if home builders don't have to pay taxes on lumber, that helps them out. So, real estate ETF, home construction ETF. Okay, well, I think it's the tariffs have a lot to do with these sectors going up and down. Okay, that was a good exercise. Let's go back to our talking points. Dan Niles picks from the beginning of the year. We have Cisco. It's doing the best so far. It's up 3.62%. Boeing is up 3.55%. And Nike is up 2.1%. Nike is going to be one of the ones that is helped the most by this tariff situation. They were paying an exorbitant amount of taxes in Vietnam to get their shoes made there. And now that that's gone, that will really give Nike a catalyst to go up. Apple, similarly, they don't have to pay taxes on all these phones they're making from India and China. That should help them a lot also. And this um, Impinj is still a loser stock. It's down 27% so far this year. So, all right, that's good to keep track of that. I picked out a couple interesting charts. You can see that we already looked at this one already. The video is like in a trading pattern for at least the past 9 months. And their earnings report is going to come out pretty soon. So this Wednesday, we'll see if it breaks out of this in the upward part or in a downward part. Not sure. Let's look at the T-Mobile. T-Mobile has been going down since last August. And you can see it broke that downtrend right here at the beginning of February. And now we're in a mini uptrend. And it's approaching all the moving averages. And on top of that, it's the 200-day moving average is turning from negative to positive. So a lot of the telecoms are in favor now because they pay a dividend and interest rates are going down. But T-Mobile isn't. They don't pay a dividend, but they're still taking market share. So we'll see. We'll watch this one. Um, we have the same stocks in our FinViz screen from last week, so there's nothing to say here, right? Anything interesting, anyways. But what I did was I looked at the Fidelity screen, I ranked every one of these um, statistics by how good they are. The green is the top 20, the yellow is the next 20. And I like to look at the stocks that have green across the line. So this GE Veranova is an example of a stock. The PEG ratio is 0.69. It's 30% undervalued. It's grown at 60%. It has all the numbers that we want from every one of our important criteria. That's an example of a stock that's hitting on all cylinders. They make the turbines for AI infrastructure build out, and they have a well-defined orders that are a backlog. So that's an example of a stock that's a quality stock. If we do have some weakness in the stock market, like there is in February sometimes, this would be a good one to start looking at. Um, I just this one just popped up this week. Look at all this green going across for AMD. They're a little bit expensive right now. They're trading at a PEG ratio of 1.6. That is like 60% overvalued. So this is what I would look at, when there's a sell-off and wait for it to get to a PEG ratio less than one. Micron, of course, is is green across I mean, has a lot of the things we're looking for. Return on investment is 45. PE is low. We have the cash flow, return on equity. Everything is great for Micron. Um, but I've noticed a lot of banks coming up in an undervalued um, low PEG ratio. We have TD Bank, we have Barclays, and we have Bank of America. So whenever I'm looking at the most undervalued sectors, if we go back to our undervalued sector, where is it here? Hold on. There it is right there. So as I do my screen, I'm looking for stocks that are the least valued, meaning um, their valuations are the lowest, and see if we have any diamonds in the rough. So the financials, real estate, healthcare, utilities, energies, I expect to have very low PE ratios. And if there's some with higher growth rates that are going to be stocks that we can hold for 10, 20, or 30 years, then that's when we start accumulating a position. Okay, let's go back to our stock screen. All right, so we have, I thought it'd be interesting to look at, um, we've been following a lot of the stocks in the top part of this. These are the higher market caps. I thought it'd be interesting to look at some um, of these stocks here, the Spotify and Vertex Pharmaceuticals. Pharmaceutical companies are very risky because they can drop 20% on a bad news story. Um, so you have to be ready for those 20% drops and or actually prepare for them and wait for those stocks to go on sale. Um, Spotify is an example of a stock. They have residual income. Um, their basic services is allowing people to listen to lists of stocks, not stocks, but songs, and they're totally at the mercy of what the companies, such as Universal Music, charge them to stream those songs. So I thought it'd be interesting. They went down a lot recently. I thought it'd be interesting to look at that one, seeing that kind of matched a lot of our criteria. We're going to look at Vertex Pharmaceuticals also. You can see that they seem like they're undervalued. Zero point 0.2 PEG ratio. That seems hard to believe, but we'll look at it. Vertex, I looked at their earnings projections, and I got this from Market Watch. And you can see that they're only growing at 5% from last year to this year, 15% from this year to next year, and then 8.5% from 27 to 28. So that's pretty inconsistent. Um, and so they're growing at, let's say, an average of 12%. Their P/E ratio is 25. Even though Yahoo Finance says they're 0.58, I have the PEG ratio at 2. So that means they're 2 times overvalued. On top of all that, they're in an industry where you're always coming out with new drugs, and you have to display the results of your drug tests, and the stock could be down 20% in a day. Let's look at its profit margin. Is great. That's almost double what we're looking for. And return on equity is 22. That is double what we're looking for. So both of those look good. Let's look at the pattern that I've seen over the years in Vertex. You can see that it drops like 10 or 20%, like once or twice a year. It hasn't done that in a while. So there's a very good chance Vertex might drop again, like 10 or 20%. And that's the way it is with pharmaceutical companies with when they have drugs they're developing, they have good and bad news from the studies. Um, this isn't a stock that Warren Buffett would buy because it's very inconsistent history of earnings. Um, and on top of that, they don't have um, they don't have a consistent earnings projections either. So I'd say it's 2 times overvalued also. So I would say for this one, wait for it to drop a lot, and then we'll look at it and see how the numbers look. Let's look at Spotify. Spotify is look at their growth rate from last year to this year. They grew 50%. From this year to next year, they're growing 27%. And then the year after, they're growing 20%. So it's decelerating growth. That is a sign that people will not pay as much for it going forward. So let's look at the PE ratio. It's 30, 31. So if they're growing at 23 and the PE ratio is 31, if you divide 31 by 23, that's a PEG ratio of 1.34. So they're 34% overvalued, and their numbers look okay. The profit margin is good. The return on equity is 2 or 3 times what we're looking for. So that's good. And they have more they have more cash than debt. So they're profitable and they don't have any debt. So let's ask Google, why is Spotify stock down? They had a weak guidance and earnings miss. So not only did they miss the earnings, they provided weak guidance. And a lot of times, weak guidance is more important than how you did on your earnings. Declining margins, gross margins has shown signs of slipping. Okay, so that is not good. And the increased licensing costs to music labels are pressuring profitability. So they're not in control of their own destiny. The um, the licensing costs could continue to go up, and they can't do anything about it other than boycott the brand. I don't know. Um, we had analyst price target cuts, leadership change. Okay. So additionally, the stock is correcting from a high price to sales ratio with investors reacting to slower than expected revenue growth. Okay, we kind of figured all that out by this declining earnings projections. It just sounds like eventually they'll turn around. It's something that Warren Buffett would not look at. Where is it? Where is the stock? Here's the stock right here. You can see it's in a downtrend, and it's still an established downtrend. Maybe someday it'll break that. It'll break out of this downtrend and start making an uptrend, I guess you can start looking at it then. I'm not interested in it because they're not in control of their own destiny. Um, their main costs for doing business are controlled by the music companies. And although I like the idea of having a bunch of computer servers and charging for using the computer servers, so you have a very efficient process, it's still it's still not going to be profitable if the music companies continue to raise the prices. Um, so let's continue to watch their earnings projection. If it starts increasing, for instance, 48, 58, 68, or something like that, then I'd be interested in it. Right now, it's not even leveling off yet. It's still decreasing. So that's not that's a good lesson learned of a stock to avoid for now. Um, just keep in mind one more thing here. There are every week we're coming up with more and more companies that are being disrupted by AI. So going back with our talk last week about Warren Buffett and how he picks stocks, we have to make sure that we think everything that we're buying through that we can't be disrupted in what we own because good companies adapt to changing business times. Like Google, for instance, they are disrupt. Oh, okay. So Alphabet, for instance, is adapting to their changing AI environment by making driverless cars and putting AI into all of their products. So they'll last much longer than um, some other companies that aren't adapting. So let's look at some of the ways AI is being disrupted. Logistics and shipping sector sell-off. Um, so freight and logistics stocks. Okay, they're being replaced by AI. Consumer real estate pressure. Um, Real estate firms like Cyber Group fell sharply on concerns AI-driven automation and remote work efficiency will reduce the demand for office space. Wealth management and advisory disruption. Software sector contagion. Increased corporate AI fear on earnings calls. Agentic AI threats to staffing models and as accelerated drug activity. Okay, so keep that in mind. We will review each of the stocks we're following to see if it could be disrupted, and if so, do we reduce our position or do we believe the company is going to adapt and thrive in the new environment? Okay. Couple more things here. The top performing growth funds. I've been going over every one of them for every week, so we're going to go over Fidelity Contra Fund as the next one, which is one of the largest, best performing growth funds. I thought it'd be interesting to look at the Contra Fund holdings from 2021, compare them against the holdings from this quarter. I put the stocks that were added since 2021, and in red, the stocks that were removed. You can see the stocks that were removed from the fund. CRM, this is Salesforce. It's a software company. It's been going down a lot this year. They're saying that their business model might be disrupted by AI. So that's an example of a stock that might not be around in 20 years. Adobe, their stock is they make animations and pictures and digital art, movies, etc. Their software might not be in demand whenever AI um, allows you to build pictures and things without their software. United Health, the whole health sector right now is being disrupted, and it is changing. It's not very profitable anymore. It used to be very profitable, and now there's new rules they have to follow. There's um, these new rules that you have to insure every American. Um, this used to be a stock that you can buy and hold 20 years, but now it's the business model is very challenging and the companies aren't doing good at all. I don't know if there's a solution to that. Um, these are kind of stocks that you have to stay away from for long-term positions. Let's look at the stocks that they've added to. Meta and Nvidia are now 12 and 10, 11% of their portfolio, which is pretty amazing. Um, we have Amphenol Corp. They do a lot of the pieces and parts for AI infrastructure. Um, we have Eli Lilly. They, of course, have one of the best selling weight loss drugs right now in diabetes medicines. Broadcom, they make chips that are custom. JP Morgan, GE Aerospace, GE Vernova, we've already talked about that. Taiwan Semiconductor and Morgan Stanley. Okay, so um, that's a good review of the changes in Fidelity Contra Fund. I like to keep track of the stocks that they hold since for the last 5 years, such as Berkshire Hathaway, Visa, Google, and Netflix, because those are stocks that might be ones that will be around in 20 years. So, and it might be a good thing for your portfolio. Here's a new story. Billionaire David Tepper goes big on Micron, Meta, and Alphabet in an AI all in. David Tepper is one of the most successful hedge fund managers of all time. And I follow every change that he makes. This is one of my favorite times of the year. Every quarter, every mutual fund, every hedge fund manager, any company that manages over 100 million in assets, they have to report their top holdings in a 13F report to the government. So I keep track of David Tepper. Last quarter, he was very big on China, and he bought his top five of his top 10 stocks were all China stocks. And now he's making the switch. What I did was I printed out his 13F portfolio that well, how it changed. I highlighted the ones that he bought a lot of recently. You can see Micron up 200%. We also had Owens Corning up 488%. Um, although, that seems like a lot, but it was only 1.5% of the portfolio. The most important stocks that I like to follow are the top 10, 15 ones percent of his portfolio. And you can see that Alibaba, he reduced it by 20%. Alphabet, he increased it by 28%. Meta Platforms up by 62%. And Taiwan Semiconductor up by 6.6%. He reduced his NVIDIA, um, Energy, and Whirlpool, and he increased American Airlines. So I saw a couple of things in here that were interesting. He's um he's like a contrary investor. You can see a lot of the home builder stocks. He is have been out of favor. Right now, he's buying Owens Corning, which is a big supplier of roofing materials for the housing sector, and he's buying Mohawk. So he's increasing Owens Corning and Mohawk by 317%, 488%. So he's like a contrary investor looking to buy to lower interest rate environment because housing will take off if the interest rates keep going down. So I thought, okay, I thought it'd be interesting to go over Owens Corning and Mohawk. Owens Corning, of course, they have that Pink Panther themed shingles and insulation. So that's their big products. And so the Owens Corning provides residential and commercial building products in the United States and internationally. It operates through four segments: roofing, insulation, doors, and composites. Okay, so they're highly dependent on the housing market and interest rates. So I'm not sure. I think I think Warren Buffett would probably like this stock because he understands the housing sector. He likes housing in general, and because he owns a lot of housing companies, and he likes a lot of some companies that he understands. And roofing, insulation, doors, composites, that kind of matches that. And 20 years from now, there's still going to be a demand for roofing, insulation, doors, and composites. AI is not going to replace that. I looked at their profit margin. It's negative 4.13%. That is not good. Return on equity, negative 1.6%. That is not good either. Total cash, more, they have 5.6, they have 5 billion in debt right now out of a market cap of 11 billion. So that's like half of the market cap is in debt. I'm not too sure about this one. Um, their growth rates from last year to this year, negative zero point 0.8. Okay, so they're growing around 10% or 12%. So if they're growing at 10%, their PE is 12. They're about 20% overvalued. For me, that's basically just not enticing. If there was a housing boom and all the housing stocks were going up, you know, all these numbers would change with the good times. But right now, housing is out of favor. I don't, I don't know. I wouldn't want this one. Um, showing PE, 4 PE has a low PE ratio. That's decent, but it's still expensive. Um, all right. I don't think I'd be interested in this one. Let's look at Mohawk. Mohawk is a company that actually creates flooring. That is their biggest product, flooring for houses. Um, so it's another housing play. So if we look at their earnings projections, they're growing around 14%. If you average from this year to the next year, is 15.5 and then 13.4 for the year after. So they're growing around 14%. The P ratio is 22. That means their PEG ratio is 1.5. That means they're 50% overvalued. All right, so the profit margin isn't that great either. It's 3.43, and the return on equity is 4.64. We want at least like 13 and 13 here too. So overall, um, these stocks would do good if the housing market was booming. Um, and they're kind of steady Eddie stocks that are going to be doing good if there was a sell-off in the stock market. Um, so it's a good way to diversify your portfolio, but I'm not interested in it because the numbers don't match what I'm looking for. Um, okay. All right. So that's all I had for today. I hope you enjoyed this talk, and I hope you have a good investing week.